So, Foord is a valuations-based house and everything comes down to the price. And, with bonds, we also have a fair value model and that sort of guides our investment decisions. And when we look at fair value of bonds, there's certain inputs that go into that. The inputs are US real rate, South African inflation, and country risk premium. And when it comes to looking at South African country risk, we don't just use the CDS as a proxy. Rather, we come up with our own assessment of what we think the forward-looking risk is for South Africa. And in order to do that, the things we take into consideration is the forward-looking growth trajectory for South Africa, the political risks that we are going into, the fiscal risks, the debt metrics, and given where we are and what we're seeing in the forward-looking environment for South Africa, we are using a much higher risk premium than what is in the CDS, and our fair value is basically coming up to where the bonds are at the moment. So basically, bonds are at fair value at the moment. They're not cheap. They're not a screaming buy given the risks that we are seeing. But, at 1 or 2% above fair value, at those sort of levels, we will start buying bonds and we will buy into that weakness. But for us, our primary objective is to protect capital. And, we believe the best opportunities materialize when those blow-ups occur. And when those blow-ups occur, and we do see them last year, bonds got to close to 12% 3 times. So we would like to protect capital going into the blow-up. And then in that blow-up, we would have enough ammo to buy then into that weakness. And then finally, I'd just like to say that, we don't feel like we're missing out too much at the moment by not having bonds. We do have exposure to lower risk assets that are giving you yields close to bond yields, such as money market, inflation-linked bonds, which are sitting well above 9% at the moment. So, we're very comfortable with the position at the moment. We think we're well positioned for any sort of risk-off event in the market. And then lastly, just to touch on SOE exposure. So, the fund at the moment from a credit quality point of view is very conservatively positioned. More than 80% of the fund is in senior Big Four bank paper and corporate paper. We have no AT1 sub-debt exposure and no SOE exposure. We've been a bit cautious on SOE since the land bank default. And also since the land bank default, there hasn't been many SOEs coming to market. That market's been sort of dead. It's really been a struggle. Names like Transnet, etc., have really struggled to fund in the local market. The only name that we have seen come to the market is DBSA. And that too, at spreads that, we don't think are attractive enough given the risk that we see in that sector.